I'm Cindy David of Cindy David Financial Group. Today we're addressing the elephant in the room: how President Trump's tariffs on imports from Canada, Mexico, and China could shape the markets, the economy, and even your asset allocation strategy. So let's dive in. Recently, President Trump's trade war escalated with him issuing new tariffs on aluminum and steel, which were implemented on March 12th, signaling his unwavering stance on trade policies. While recent executive orders imposed tariffs on Canada, Mexico, and China, last-minute changes delayed those targeting Canadian and Mexican goods on everything else, which was supposed to take effect by the end of February, earlier than the aluminum and steel start date. The tariff on China did go into effect, only later to see a key provision on exports under $800 repealed. While the delay of Canadian tariffs, following a last-minute discussion between Trump and Prime Minister Justin Trudeau, brought temporary relief to Canadians, the swift implementation of China tariffs reminds us that Trump's threats are not always mere posturing. As of right now, the 25% tariffs on Canadian goods is going to materialize, and Canadians should be wise to prepare for this scenario. Now let's discuss various market implications and some proactive strategies to protect your wealth and navigate the uncertainty of future Trump tariffs. First, you should think about diversifying your currency holdings. One immediate consequence of tariffs could be a depreciation of the Canadian dollar against the US dollar. Since Canada sends 70% of its exports to the US, a reduction in demand for Canadian goods could weaken the Canadian dollar. To safeguard your purchasing power, consider holding multiple currencies. The US dollar is an obvious choice, especially if you travel to the US or are engaged in cross-border transactions. Alternately, consider currencies less tied to Canada-US trade to further diversify your exposure. Another way to protect your portfolio is by shifting some investments to global equities. Stocks in regions like the UK, Japan, or China, excluding those heavily affected by the US-China tariffs, are less exposed to North American trade dynamics. And I think the key message here is to make sure your investment advisor or portfolio manager is making sure your investments are less exposed to these dynamics. Beyond the immediate benefits of shielding your portfolio, investing globally aligns with the principles of diversification. Academic financial theory suggests that a well-diversified portfolio spreads risk and enhances returns. So adding non-North American stocks to your portfolio can provide a bit of an advantage while safeguarding against trade-related volatility. Many experts, including myself, feel that the 25% tariffs on Canada and Mexico will be short-lived. Why? Because Trump and his administration, they're unlikely to risk economic growth or trigger inflation by keeping these tariffs in place for long. The move may be a negotiation tactic to speed up revisions to the US-Mexico-Canada agreement. And while Canada and Mexico have announced retaliatory measures, I do believe the economic impact of the tariffs could lead to some concessions. Trump uses tariffs as leverage to address broader issues like immigration and the opioid crisis. I expect tariffs to be temporary until politically acceptable solutions are reached. The economic impact, however, depends on how long these tariffs remain in place. You should brace for short-term volatility, which we're already seeing, and focus on diversification, hedging, capital preservation. And while I do expect the S&P 500 to rise by year-end, I cannot emphasize enough the importance of managing the downside risk during times of uncertainty. Tariffs will likely weigh on markets in the near term, causing all of this volatility until there's more clarity on the US trade policy. High-grade bonds, gold, they're often good hedges against uncertainty and inflation. For experienced investors, certain hedge fund strategies could offer attractive risk-adjusted returns. Again, if you haven't heard from the person who is in charge of managing your wealth, pick up the phone and make sure you're well-informed and comfortable with the strategy that they're proposing. As with anything, it's important for you to understand what's being recommended and that you be comfortable with it. With all that said, this is not the time to panic. With any market downturn or economic uncertainty, there's always opportunity. You just want to be on the right side of it. I truly believe this is a great time to make sure you're getting good advice from your team of advisors, and so communication is key. You should not feel in any way that you are being left in the dark or forgotten. If the squeaky wheel gets the grease, then let's make some noise. I'm Cindy David, and I am here to help you sleep at night. So remember to click the subscribe button and get more insightful videos on me. Thanks for listening.